Hi there, welcome to the Business Tools series. I'm Ray Brown, CEO of ArchiBiz. And this is the first in a series of educational tools around business that will be put on YouTube but also will appear in the Business School for Architects. And I encourage you to check that out. So today's topic is the profit and loss account. Now, we're not trying to turn you into accountants, and I can tell you that I was 38 and I'd owned two businesses before I really realised the difference between a P&L and a balance sheet. And I find now as a business coach, I speak to many business owners and they kind of fumble around when you ask them, what's the P&L and what's the balance sheet and how do you use them? So we thought we'd prepare this series of tools explaining really in simple terms what these business tools are all about. We're not trying to turn you into an accountant. You don't need to be an accountant to understand these. Think of it more like your scorecard. So your financial reports it tells you whether you're winning or losing. It tells you where you're winning and where you might be losing and what you need to do more of and what you need to do less of. So let's start today with the profit and loss account. And the key question is, what is a profit and loss statement? It's sometimes called profit and loss account, sometimes called profit and loss statement. In simple terms, it's a record of income and expenditure over a period of time. Now, there's some really important things to get in your mind here. Probably you look at the profit and loss once a year with your accountant and he tells you whether you've made a profit or not. But really you should be looking at the P&L every month because it's such a valuable process to look at your profit and loss in conjunction with hopefully your budget. But we'll speak about budgets in a later episode in this series. So a record of income and expenditure, not cash. Okay, this has nothing to do with cash coming in, cash coming out. Of course they're linked, but think of it as your value earned in the month. So hopefully you can send invoices for all the money that the value that you've created in the month. But if you can't, then ideally the profit and loss should record that total value of the value that you've earned in that month, so that you can look against that and look at the expenses for that same period, and the difference between your income and your expenditure will be profit. And profit is an absolute essential in business. In an architectural practice, there's almost a thought that profit is a nice to have, not an essential. But profit is where you can invest in your business, where you can build up a war chest for a rainy day. We know that architecture can sometimes be peaks and troughs, feast and famine. And sometimes you need, if you're going to keep your team together, you need money in the bank so that you can pay the expenses through those difficult times. So let's have a look at the profit and loss and how it's structured. And I want to keep this really simple, and I want to start with a retail example. Think of it as a sweet shop in the UK or a lolly shop in Australia, candy shop in America. So you've got sales. It can be $500, $5,000, $500,000. P&L looks the same in all of these situations. So in a shop, in a trading environment, you will typically have direct costs. And direct costs are those costs directly associated with a sale. So in the case of lollies or candies, you would have to buy the lollies so that you can sell them. And if your sales double, chances are that your direct costs will also double. And the difference between the sales and the direct costs are what we call margin. I like to call it the gross margin. Some people call it the gross profit. I don't like the profit word coming in so high up in the profit and loss because you haven't made profit until much further down in the P&L. A key thing here is the percentage. So what percentage margin are you making on the work that you do? And in a context of an architecture practice, we will come back and speak about this when we look at the projects. We think of an architecture practice in the 4 Ps: the practice itself, the projects, the people, and the perception, or the sales and marketing. How do you attract business into your practice? And the profit and loss relates very much to the practice itself. And that's a key starting point. Are you creating more value than you're costing in expenses? And if you're doing that, chances are you're making a profit. So in this, back to the trading example, we've got sales of 500, direct costs 250, we're making a 50% margin. And we need to keep an eye on that percentage, because if that percentage drops, then that has a very detrimental effect on our profitability. On the other hand, if we can increase that gross margin percentage, then that savings will drop to the bottom line, as they say, and increase your profit. So the next item are the overheads or fixed costs. So if you think the lolly shop example, these would be things like wages and rent, electricity and other items that you have. And they're called fixed costs or overheads because irrespective of how much you sell up at the top in sales, you need to pay the expenses. You need to pay your staff, you need to pay the rent and electricity. And if you've a really quiet period in a trading business, that's just a problem. You'll make less profit or no profit in those times. So there we have a total overheads of 200, and our gross margin effectively goes to pay the overheads. Therefore, we make a profit of 50. Could be 500, could be 50 million. That's the layout of a profit and loss account. Very simple. Ideally, you want to be comparing that actual numbers on a monthly basis with a budget, but as I say, we'll come back to preparing a budget in a future episode. So let's look at profit and loss in the context of an architecture practice, which tends to be a little bit different. So we have sales of 500, still the same, but at the whole of practice level, we wouldn't normally be speaking about margin. We would speak about margin in the project context, and we will come back to that in the future. But at the moment, let's just think of the P&L as sales, then less our overheads, and these are your fixed costs. So the fixed costs, the wages and salaries in an architectural practice tend to be relatively fixed. You may get rid of people, you may hire people, but they're not going to come and go, and that number's not going to fluctuate too much month by month. So therefore, you know what your overheads are at 450. And that 450 is really what constitutes your break-even number. If you had 450 in the top line, 450 of overheads, you'd make zero profit. So that's how a business breaks even. But breaking even is not adequate. You must make a profit. And this business here is making a 10% profit. We would encourage you to aim higher than 10%, somewhere in the range of 15 to 20%. And we've coached lots of architectural practices all over the world, and with the right systems and processes in place and the right understanding the numbers and the operation of an architect's practice, 10% is definitely doable. 15% is fairly normal for our clients, and we have got some clients who make 30% net on the bottom because they operate a very tight practice. They get really good fees and they control their costs, therefore they make really good profit. So that really is the profit and loss. It's very simple. I encourage you to look at it monthly and to understand it monthly. The chances are that you've got an accounting system that if you learn the basics of that accounting system, it will produce this for you. And your accountant can help in getting you familiar with the systems so that you can produce, hopefully, a profit and loss compared to the budget. But as I say, we'll speak about that in a future episode. Thank you very much. I would encourage you to check out the Business School for Architects. We will be putting these videos in the classroom there, and they'll be there for you to refer to in the future should you want a refresher. Thank you for watching, and I'll see you in the next episode.